Now, you and I were talking this morning, and we were having a discussion about what we were going to talk about on Friday Fun Day.
Hmm.
You're building the outline and the design for a course on investing, for tackle trading. And
Yep.
we were having a discussion about the principles of value investing. And I thought it was really fascinating. And I love the idea. Let's get into that topic here for a few minutes, kind of set that up, describe what value investing is. And then you had three principles that you were going to talk about. Is that right?
Well, they're not my principles. They're value investing principles that have been around since. So Benjamin Graham wrote The Intelligent Investor, 70 years ago. So in all the different editions of it. And, it's we do so much from a trading perspective at Tackle. I mean, everything we do in our coaches shows. I mean, that's what we primarily do in our halftime report. We certainly do some cover calls on long-term investing, but what we felt like it was is important for our community to have a little bit of a understanding of what investing really is, right? And quite frankly, the term value investing has been doctored to a certain extent along the way, like many words and many philosophies, right? So
Mhm.
value investing, the father of value investing, is a guy by the name of Benjamin Graham. Famous value investing, famous made by Warren Buffett, right? And value investing has been a part of mainstream American conscious from in the investing community literally for 70 years now, right? Since 1949, 1950. Benjamin Graham believe he was a Columbian economics professor. He was Warren
Mhm.
Buffett's mentor as well. And he's one of the most, quoted and looked upon investors of all time. Literally, he was Warren Buffett's mentor. And if you have never read the book, The Intelligent Investor, please go read that book. It is an amazing book. And some of the later editions, they update the editions as time goes on. And some of the later editions, I really like it because what it does is it'll have what Benjamin Graham wrote in 1950, but then it'll have an update of how it's applied to this marketplace. And as I've been reading that book again, I literally, I'd learn new things every time I read that book, right? But as I've
Mhm.
been reviewing and reading that book again, one thing that the conscious just kept coming into my thoughts: what would Benjamin Graham think about value investing today,
Mhm.
right? Because value investing has been changed over the years. Like, for example, value investing was not originally just investing companies. In fact, that's how it is today. It's like investing companies, right? But Benjamin Graham actually warned against that. He actually warned against that because he said there's inherent bias in the things like for example, we work for a company, and so we like that company, and so we invest in those companies' shares, and we have our entire 401k in that company because we work for that company. We think it's a good company, but is it truly a good company? Is the underlying business model truly a good business model? Is it a profitable company? Is earnings per shares increasing? Is the price not overvalued? There's more that goes into it, and just invest in things because again, there is a confirmation bias in that capacity. I love XYZ company, which means I might not be able to, analyze that company with clear eyes. I can't stand Goldman Sachs. They absolutely drive me absolutely crazy. I'm inherently biased against that. So you know what? I typically don't trade Goldman Sachs, right?
Mhm.
Because I'm inherently biased against a company like a Goldman. So it's not just about investing in things that you know and you love because of confirmation bias. When you decide to invest in a company, you have to look at the underlying principles of that company. And Tim, it starts with looking at companies that you're familiar with, right?
Mhm.
Like with Warren Buffett and his famous story of how he invested in Coca-Cola, right? And this is where a lot of the misnomers come from, where that story starts with, well, I invested in Coca-Cola at such a young age because I was drinking a can of Coke and I liked it. And then Peter Lynch in the 80s and Peter Lynch with the Magellan Mutual Fund was a rock star. I mean, one of the best in the history of mankind. And Peter Lynch changed it to a little extent. And he said, okay, yeah, let's invest in things we know because we're familiar with that. And that became like, Tim, there was this philosophy in the 80s and 90s and even today, like, okay, the analysts on Wall Street don't know if the parking lot at your local company is full, but you do, right? The analyst doesn't know if the steakhouse is full, but you do. That's where that comes from. Invest in things you know. But the reality is, if you go back, and there's nothing wrong with investing in companies you know and companies you work for and companies you like. I'm not suggesting that, but that just starts the idea. You still have to answer these three underlying principles. Number one, Graham's rules for an investment. Number one rule for investment: you must thoroughly analyze the company and the soundness of its underlying businesses before you buy the stock. So if I have an idea that I like XYZ company, that I think it's a good company, I can't just rush out to buy that stock right then because of the fear of missing out, right? I need to go in and I need to truly understand their business model. I need to truly understand their underlying principles. I need to truly understand valuation and earnings and forward guidance. And I need to understand the underlying. And if at that point I like the company, then I invest in that company if it is the right time from an economic perspective, and if it is a fair price from a valuation perspective. Principle number two, you must deliberately protect against serious losses. You have to be risk adverse. You have to be in value investing. The two competing principles of investing really are value investing versus growth, right? Value investing versus growth. In growth, you have a higher appetite to risk. In value investing, you have a lowered appetite to risk. So in value investing, you have to deliberately protect against serious losses. And you do this through a couple of different ways. You do this primarily, and Benjamin Graham was not talking about buying a protected put option, guys. That's the evolution of the market. That's the evolution of traders over time, adapting those fundamental principles of Benjamin Graham. What he was talking about don't invest in a company that's overvalued, right? Find good, fair value. And he talked about, oh man, I can't remember the guy's name, a famous individual, and I had it on top of my head earlier today, and I'll look it up later. But Tim, he invested in the East Trading Company. This
East
250
India
years
Trading
ago.
Company.
Yeah, 250 years ago. And he invested at the foundation, right? And he made like $7,000. And I don't know what the equivalent was. That was like $1.2 million in today's prices, right? And he had closed out because he felt like that company was overvalued, and he had locked in 100% profit. But then the euphoria of the market, and we're kind of seeing this in this market right now, the euphoria of the market of this just started going up and up and up and up and up and up. And so you know what he decided to do? He decided to invest another $20,000 at a higher price as the market was getting euphoric, and he lost all of it. And I forget the guy's name. Somebody help me out with that guy's name. But basically he said, if anybody ever utters the words, the South Indian Trading Company again, you're out of my world, right? Because that individual missed out on one fundamental principle. You don't chase the dream. You don't chase the dragon. You don't get caught up in the euphoria of the short-term market by buying overvalued companies. How you protect and deliberately protect against serious losses is you buy great companies at a fair market price, right? And then principle, and in today's market, guys, how we go about this is we don't look at a lot of different things. A PE ratio is just a very sound way to utilize whether or not you're paying a fair price for a company. And if we need to talk about PE ratios down the road, we certainly can do that. And then number three, Tim, you must aspire to adequate and not extraordinary performances. And that's extremely important in value investing, Tim. You have to shed the growth mentality, right? The growth mentality is, I don't get paid a dividend. I don't care about that dividend, because the company like Google, who doesn't pay a dividend, but in my opinion should pay a dividend, they don't pay a dividend because instead of paying a dividend out to their investors, they reinvest that money back into their company, and that creates a growth-based environment. So a simple understanding of dividend payments versus non-dividend payments is a really good understanding of what value investing is versus what growth investing is. But value investing is not about going out there and hitting 35% ROI. Value investing is not buy and till rate. Value investing is not buying US Steel. Value investing is not buying these growth-based companies. Value investing is buying a utility company and expecting a 7% ROI on a yearly basis. Compound that with a 3% dividend payout. You cash out 10% on a year, and then you offset that through inflationary cost, and you're really kind of taking in 7.4%. You have to aspire to those adequate performances instead of the rock star performances. And where this really comes into full, Tim, is when you're talking about portfolio design and you're talking about, okay, what percentage of my portfolio should I have allocated to value investing and safety plays like bonds and dividend paying stocks and whatnot, versus what percentage of that portfolio do I want to put in more aggressive areas of the market, not get a dividend, and where do bonds and treasuries fit within that as well. So it's simply an understanding. And I just want to talk briefly, Tim, about just value investing, because it's not just investing in companies. In fact, Benjamin Graham warned against that. It's about investing in companies that are good companies, pay a dividend, that you're buying at a fair price, that you know are going to perform over a 10, 20-year horizon versus a 1 to 2 year horizon.